Hello everyone. We're just going to give it another second or two to make sure people are able to join. Okay. Hey Alice, hi Andrew, David, Ken, Mario. Nice to see you, Vicky. Okay, I think most people are in now, so we can kick things off. So, hello everyone, and welcome to episode 4 of Crowd Powered, our series looking at what crowdfunding is, how it works, and also designed to help you understand if it's a good fit for your business. Now, during Crowd Powered, we invite founders and industry experts along for each episode to come and talk to us about the pros and cons of equity crowdfunding, how it compares to other forms of capital raising, and also to take a wider look at the general fundraising landscape in Canada. And to do that, for today's episode, I'm delighted to say that we have Matt Cohen joining us from Ripple Ventures, who's going to talk to us a little bit about fundraising from the VC's perspective. Great to have you with us, Matt. How are you doing?
Great to be here. Thanks for having me.
Fantastic. So over the next 30 minutes or so, Matt and I are going to cover 3 main topics. We're going to talk about the funding cycle for startups. Matt's going to run us through his investment thesis. And also, most interestingly, certainly for me, he's going to share his thoughts on equity crowdfunding. But before we dive into those things, Matt, I'd like to hand it over to you. If you could tell us a little bit more about you, your background, and also a little bit about what Ripple Ventures is and kind of what you do as an investment firm as well.
Yeah, absolutely. Thanks again for having me. So my personal background before getting into startups and venture capital, I spent over a decade working on Wall Street, working for a Canadian bank, RBC first, and then over to another Canadian bank, National, for a couple of years. And I was in charge of managing a lot of the merger arb and event-driven hedge fund relationships. So that was, typically long short hedge funds, trading large, assets back and forth on, the global exchanges. And I was spending a bunch of years living in New York during the crisis, so got to live through that time, which was pretty exciting. If anyone has ever seen the Flash Boys book by Michael Lewis, there's a very famous character in the book, Brad Katsuyama, so got to see that happen live in front of me during that time. So that was where I really started my investment background, public markets, understanding risk, understanding portfolio construction, and how to assess sort of market dynamics in the public realm. Never really had much experience on the private side. It was always post-IPO stuff that I was focused on in my own personal and professional life. However, in 2012, I moved back to Toronto, Canada, after living in New York for several years. And I ended up starting a tech company with 2 friends. They were the 2 founders. I was the founding investor. And it was a Wi-Fi marketing analytics business called Turnstile Solutions. That business was essentially bootstrapped for the first bunch of years. There was a very small venture capital ecosystem in Canada, let alone Toronto at the time. And we had really tried to pitch about 300 investors to try and invest in our angels rounds, and we did not have much success. And so we had to figure out the hard way on how to make our resources go farther, how to recruit people to come and work for us, and all the things that small businesses deal with day to day. So there was no crowdfunding at the time that we started that in 2012. But fortunately, after getting the company to several million in recurring revenue, we ended up selling it to Yelp for about 30 million Canadian. And it was a great exit for the founders and some of the early angel investors that we ended up bringing on near the end of the journey. So that's how I got my way into sort of early startups and building. At the same time, I went to go work for a fintech company that was based in Toronto, was moved down to Boston and partially New York as well, working as a director of enterprise sales, selling large enterprise SaaS contracts. So that's where I learned about the operating side, about actually building and scaling an enterprise SaaS business. And while I spent time living in Boston, I got exposure to all the cool, startups being built out of, MIT and Harvard and Cambridge ecosystem there, and just spent all my free time hanging around, the angel events and the community that was being built, and started, making some angel investments myself. Now, again, crowdfunding was not really something that we had. So what I was doing was pounding pavement, putting together my own presentation of myself, really, as why founders from MIT and Harvard should even take a meeting or a call with me. So I had to set up something that was more elaborate than mattcohen@gmail.com. And so I ended up creating Ripple Ventures as my own portfolio company name for my angel investments. And fast forward, after doing that for a couple of years, making a dozen investments, having some very nice exits myself as an angel investor, I started to get some, respect and attention from the family offices in Canada and some in the US, asking if I would make some angel investments or, early stage venture investments for their family offices. And long story short, I ended up gathering $10 million for my first fund in 2018. That fund has already deployed, all of our capital into 10 companies. We've sold 2 companies already, about to sell our third. And we've been running a venture fund since 2018. We've now got 25 million under management, 2 funds, about to announce our third fund. And we are predominantly focused on early stage B2B SaaS investments, which has now expanded into developer tools, creator tools, and obviously Web3. And we are a team of about 6, focusing predominantly on Canadian US startups. And yeah, that's a bit about us.
That's fantastic. Thanks for sharing that. That was really interesting to hear. And I think one thing that stands out to me is you've done it from both sides, if you know what I mean. You know what it takes kind of growing a business, and now you're sort of on the other side of the table, as it were. And I think that's a great place to start our conversation, and in terms of looking at the funding cycle for early stage startups. And maybe you could tell us a little bit more about, in your experience, both as a founder and as an investor, what stage should you start that process of looking for external funding?
Yeah, I think, it should start from day one. I think you're always selling. I know Richard Branson says that there is no entrepreneur that could build, sell it, and fundraise for a company all at the same time. So you have to be doing all 3 things: building, selling, and fundraising all the time. Even our companies today, who are, Series A, Series B funded companies, they're still fundraising every quarter with either a quarterly update, a catch up, a coffee with future round investors. So you're always selling and you're always fundraising. But when should you consider actually fundraising and taking on people's money? Well, that's a different question these days than it was, because a lot of people are getting heavily funded before they've even left their current jobs because the market is so frothy. But I would say overall, when you should be considering fundraising for your company is when you really understand how to deploy that capital. Meaning, do you have a clear sign of not just a budget, but actually how you're going to take that capital and return multiples in value, whether it's in the form of appreciation in the value of your equity or in actual revenue. So what we always say to companies is, it's never been an easier time to build a company, especially with like remote work and, globalization of labor. You can literally go on Upwork and build a prototype. I've had friends literally still in their current jobs build a hardware device prototype with their own money before they've raised any fundraising, tested it out in the field, made sure it worked, and then they went to their family and friends and did an angel round. So we're of that mindset that you definitely want to make sure that you've been able to prove out that there is something that could be a business here, or a great investment opportunity to investors with your own time and money first before you go out and fundraising. But I think the conversations can be happening quite earlier than that. And the last thing I'll say is you should never go out with a first conversation looking for money. It's always better to ask for advice and opinions and share your thoughts and feedback before you actually start asking for money. So that would be like the definitely starting point for me.
So I guess what you're saying is kind of basically fundraising is a part of the DNA of having a company, right? Like, yes, you have your customers and your team, but fundraising should always be top of mind. And I guess related to that, can you walk us through a little bit when looking at, for example, raising money from a VC? What's a typical time frame that you can expect as a founder? Let's take a scenario. I don't know. I have 6 months of money left in the bank. Is this a good time to be talking to a VC from starting those conversations to having it sat in my account, or am I too late by that point?
I mean, yeah, 6 months is probably the soonest you would want to get up to the drop dead date is what we call. So what we typically ask our companies to forecast is kind of 3 scenarios. Always is 0 growth and current burn staying the same, and that's their drop dead date. Then there's a conservative growth scenario where revenues are slightly growing and they're still burning the same, and what's that drop dead date look like? And then on a regular growth path and burn slightly increasing, what is that drop dead date? And so in the worst of the worst scenario, so 0 growth and consistent burn, what is that drop dead date? And yes, 6 months is like the bare minimum. 3 months is really tight. And we've had companies that have like closed a deal with 3 months left, but that's because they started the conversation at the 6-month mark. So yeah, 6 months is a good barometer for kind of where you should be thinking and starting. But in terms of like how long, I mean, VC deals could close in weeks if it's a safe note, and if it's a if it's a pretty early stage company, or people know the founders, they're second time founders, third time founders. Like there's no cookie cutter way of explaining how fast a VC deal can close. For us, if we're leading around, which we typically do, we are first call, meeting with the team, second call, meeting with the partners. Then we decide if we want to take it to the next steps. And then our due diligence process from after second, third call meetings is probably about 3 to 4 weeks. And then we go full deep due diligence, setting up a data room, going through all the financial due diligence and reference checks and market business due diligence. That would be like a 3 to 4 week from like, deciding on term sheet to close is where things really have to move fast. But before that, you can get on a call and do a couple of meetings with a founder team in a week.
Yeah, there's lots of variables there, right? As you say, kind of it can happen a lot quicker than you expect, but can also take a bit longer too. And I guess related to that, and you kind of touched on this already in your previous answer, but if you're a first-time founder looking for funding, what are some good things that you can do to prepare, not necessarily to expedite that process, but to make sure you're ready? So I know you touched on the forecasting, the scenarios of what you might call an optimistic one, a sort of realistic one, and a pessimistic one. What are other things that, for example, you should know of like the back of your hand when you're talking to a VC, and other things to prepare to kind of make sure that process goes well?
I mean, first-time founders are obviously going to have a hard time fundraising when they're going out to the VC market. So like, don't try and go after the biggest fish if you don't need to right away. Like just try and get the business off the ground. So family and friends, angels, networks, accelerators, all those things are still viable and very good ways to get yourself going. It also allows you to make some mistakes without having to like completely burn a bridge with a potential seed lead investor or pre-seed lead investor. But I'd say like the biggest things you need to be aware of is one, why is this a problem that you want to spend the rest of your life, dedicated to solving? Like really need to understand, why is this your passion project? What is motivating you? What personal problems have you faced in this, situation that leads you to want to actually focus on this for, 24/7 for the next several years is really important. The why. The other part is, the how, right? Is, what's the team going to look like? How are you going to solve this problem? And what is your vision for how you think it's going to be, built today versus, maybe 2 to 3 years out? And then the last thing is the market, right? Like it's team and market, because there's probably very limited product to show in this early time. Why is this market? Why is the total addressable market, the TAM, something that investors should get excited about? Sometimes we've seen decks where founders say, this is the size of our market, and we've already captured 10% of our market. They think that's a good thing. That's actually a terrible thing. If you say you've already captured 10% of the market, and you've only started really, or you've only been at it for a couple of years, like most, great, public companies don't even have 10% of the market, besides like the $1 trillion, the FANGs and stuff. But, 10% ownership of a market or control of a market is a lot. So you want to make sure that the market is growing and is big enough, and you also have the ability to explain why you're going to be able to grab share from your competitors and what you're doing differently. So it's a mixture of like, vision, team, market is what we're talking about.
Do you have any resources or things online you recommend people should look up? Go and check out this blog, or this VC firm has some great things that you might want to learn about that will kind of set you up to be able to answer those 4 key questions well.
Yeah, so I have something even more than that. We actually built our own curriculum and program for this when we were building Ripple. So just to give you a bit of history, like I went to school in East Coast of Canada in Dalhousie University. It was a co-op based commerce, finance, economics program. My partner, Dominic, went to Waterloo to do his business accounting finance program. And he also was a co-op. And he and I both realized that co-op jobs were just not cutting it for when students needed to learn about technology, startups, and building companies. And so we decided to create our own program called the Ripple X Fellowship Program. It started 3 years ago. I can share the link after, but it's fellowship.rippleventures.com. And what we decided to do is build an online curriculum to teach future founders and future funders on how to build startups and how to invest in startups. At first, we only offered it to university and college students across Canada, the US, because it was a one-on-one mentorship program. We did it every semester. So there was 4 a year. We started getting applications across the US, and it grew from like, just a couple dozen students to now hundreds and thousands of students. And then at the end of last year, we rebuilt the entire curriculum and made it publicly available online for anyone to sign up to. So there's a public available course, and then there's a private course. The private one is where students get accepted. We get hundreds of applications. We only take about 10% of them, but the public course still has all the same material. You just don't have the one-on-one approach. So I recommend any listeners going to the fellowship website. We have a ton of great resources for future founders and future funders. We also have our own Tank Talk podcast, which we talk about every week. We release on Thursdays. It's tanktalks.substack.com. And you can listen to stories from founders, investors, and operators, how they talk about their businesses and the problems they're solving. So those are two self-promoting suggestions. There's so many other resources out there that I'm sure a lot of your community knows about. There's SaaStr, there's the All In podcast. I think podcasts are great. 20 VC podcast is a great one by Harry Stebbing. So I'm sure there's a ton of resources your audience knows about already.
No, there's a wealth of knowledge there, definitely, and we'll definitely put both of the links to those in the follow-up email as well. And I listened to the one with is it Austin Reef from Morning Brew that you did? That was really interesting. I really enjoyed that. So I can vouch for it too. Yeah, it's awesome. I'd like to jump from there over to, again, we've touched on this a little bit, but if you could talk to us a little bit from a VC perspective on your investment thesis. So, I'm sure you get a lot of pitches. You're very connected in sort of the fundraising space within Canada. What do you look for when you're deciding on an investment? What are the things that stand out to you and you think, yes, I want to learn more about this?
Yeah, so we're very transparent when it comes to what we're interested in. On our website, rippleventures.com, we have a thesis page to explain to founders if they fit our thesis and whether or not we'd want to talk with them. But to give the audience a sense of what we're looking for, we're an early stage fund. So what does that mean? Typically pre-seed, seed, and early Series A, call it seed plus, is where we like to invest. We like to find companies, if they're in those buckets, let's say it's at the pre-seed stage, obviously the company is probably only looking to raise, $500K to a couple million, pre-seed rounds have gone up a lot these days. And they've got some product that they've obviously got able to show, and they've got, maybe some pilot customers, but it's still pre-revenue most likely, and we're okay with that. And so what we're looking for at that stage is really the team, a little bit of product development, and velocity of how fast they're able to iterate on feedback and just sort of, not pivoting, but, iterating on the business. Secondly, at the seed stage, it's really more about like a little bit of the metrics, a lot about the product and the go-to-market strategy. So we want to find companies that have, some decent pilot customers, some good initial traction revenue, and then a really good product, and then a good vision for how they're going to go to market and get the product market fit fast. So those are the seed stage companies where we'll write, $1 to $2 million checks. At the pre-seed is kind of 250 to 500, depending on the size. And then at the seed plus early Series A, that's really metric driven. So it's, they've got some good, metrics on their CAC to LTV ratio, their net dollar retention, their gross margins, their ACV and expansion. Like it's much more SaaS metric focused at that stage of company. And then we basically say to them like, hey, we're going to give you $5-10 million from the fundraise. How are you planning on deploying that capital? We want it to be very scientific for them. Obviously, they're going to take some bets and make some mistakes, but it's much more, quantitative than qualitative at that stage. And then in terms of like where we're investing, as I mentioned, it's predominantly B2B enterprise SaaS with developer tools, data science, AI, ML tools, as well as creator economy, and then Web3 as well.
I want to jump into a couple of questions we got in about this event here as well, because there are a few questions about kind of assessing investments, particularly from the VC perspective. One I found really interesting was Abasali sent one in about there's been a growth in the amount of data available. Data is the new oil, and there's so many metrics and things that you can measure, and people can provide you with information. Has that impacted how you assess investments over the years, and how?
Yeah. So if it's a question on like, how do we use data to our advantage when finding companies, or is it how are we looking at companies utilizing data for a potential investment? I'll answer both.
Sure.
So for us, when we are using data for sure, we actually have an outbound data scraping and sourcing strategy for finding new companies. So we have developed an in-house proprietary model on how we like to find companies based on how long they've been around, how many employees they are they growing, how much capital they've raised, things like that. And we are able to scrape and find some pretty unique companies that are either bootstrapped and they maybe consider venture back, but they're not being looked at from a lot of the venture community. So we actually find some really great companies that way. On the investment side, when it comes to looking at companies that are utilizing data, we actually have a data scientist on staff. He's an incredible data scientist, product manager, leader, and an MBA. So he's got a finance background as well. And we utilize him a lot when we're looking at a lot of the data, AI, ML, developer tool companies out there. And unfortunately, for a lot of people out there, there's a lot of lipstick on a pig in the data and AI space these days. A lot of people are, claiming they have the best tool for analyzing X, Y, and Z. And unfortunately, there's a movement that's happening lately called low code, no code solutions. And a lot of those solutions have been able to take a lot of those, heavy sets of data and make them more usable today, basically making a lot of these startups irrelevant or very focused on a niche segment. So when we look at a company that's claiming that they use data and AI and ML technology, we actually do care about what their proprietary edge is in building and processing large amounts of data and the application to it, because it's not enough nowadays to say we have access to a lot of data and we know that the market is going to demand it. Well, data is everywhere, and there's a lot of tools out there that you can get for free, honestly, online to process and access that data. So the game has changed a lot for a lot of companies who now are coming to us saying, hey, we're AI ML focused and we're doing this. The bar is much higher.
And another question related to investment thesis came in from Wayne, which is obviously you have the data side when you're assessing investments Ripple makes. Do you consider social and environmental metrics as well? So he's asking about things like diversity and inclusion. And if you do, how do you measure those things?
So we have built our own DEI framework for ourselves when hiring for our own team, as well as for investments, but we are not basing our investment decisions solely on that. What we try to do is we do a lot of reference checks, either ones that they provide or ones that we find ourselves. Social impact and DEI focused funds have a much higher bar than we have. And that's because we're not claiming to be a DEI or, social impact focused investor. That's not, we are capitalists and we are here to make money for ourselves and our investors is definitely the name of the game. But of course, we want to make sure that there is the diversity initiatives being made at our companies that we invest in. And so if they don't have one, we'll still invest, but we give them our DEI framework and guide them on how to become much more. Remember, we're also at the early stage. So, DEI at the early stage is not the focus because there's so many other fires that are burning at an early stage company. So to be having that as a core pillar at the pre-seed stage is like almost irrelevant when there's like 3 people in a garage. But as a company starts to mature and we work with them because we're lead investors, that the Series A and beyond stage, absolutely, we're giving them a lot of frameworks and we put a lot of support around them to make sure that they have a social impact and DEI, pledge on their roadmap to being more, impactful.
I've got one eye on the clock here. We've covered a lot of ground, but I do want to get into the third topic as well, which is to talk a little bit about giving us your thoughts on equity crowdfunding. So I think the first thing that I wanted to ask you is, what do you think about equity crowdfunding if you have your venture capitalist hat on? We spoke about how the space has changed a lot. That's not really something that existed 10 years ago. How do you see it now?
Yeah, I think it's fantastic. I mean, I think equity crowdfunding and sort of syndicates and rolling funds and SPVs and all that are all great things for democratizing access to the alternative investment class. The more people we have investing in this asset class and learning about it and building with us, the better. The same thing for me. When I started building my venture fund, there were other venture funds that said, hey, we need more people like you, more emerging managers, more early stage investors, helping, founders, hand in hand, trying to get their companies to grow. So the more the merrier, I think is great. I definitely think for us, if we had it when we were building Turnstile, who knows what outcomes we would have had, that would be definitely something I would be, happy about.
And I know you're kind of operating a lot with slightly earlier stage companies, but it is possible for a fairly early company to do a crowdfunding raise. What would Ripple's approach be, or how would you react if a company came to you and said, look, we have just done an equity crowdfunding round? Is that something that speaks to you in a positive way or a negative way, or perhaps a mixture of both?
Look, I think for us, any way you can get capital, as long as it's clean and kosher into a business, is fine with us. We've actually helped a lot of our companies at the early stage not do like an equity crowdfunding round on a platform like yours, but we've helped them pitch to dozens of angels, and we're the lead investor. So we'll jump on a Zoom with all the other angels, and then they'll roll themselves into an SPV vehicle, which is very similar to the equity crowdfunding model. It's just that these are angel investors that they know from their network, whether it's a bunch of doctors or a bunch of lawyers, whatever it is, they're selling their software to, and they're strategic and value added. We're happy to jump on a call and share the story and why we're excited about, writing the largest check and leading the round. So I think having a diverse group of investors, as long as it's not a distraction, as long as they don't try to get in the way and control the business, and as long as the cap table is clean, we're 100% supportive of it.
No, that's fantastic, and it's really interesting to hear. And I think also that is a mind shift change that has happened. Maybe as we see more companies come through that have done or leveraged equity crowdfunding really successfully. One thing that always stands out to me, again, if you roll the clock back 10 years, is VC money and equity crowdfunding are almost seen as in competition with each other. You do one or the other. One goes in fashion, one goes out. What I see now from where I'm sat is very much a complementary approach. You can do both at the same time. There are also VC funds that crowdfund part of their own fund. So maybe could you share a few thoughts on how you see the two coexisting within Canada for the better of everyone? It helps businesses, it helps investors. So maybe kind of that coexisting and looking at like, what does the future look like for fundraising in Canada?
Yeah, I think, we are obviously democratizing, access to the asset class and to, small businesses and startups. And the more people that are aware of it, the more people that are talking about it at the dinner table and at the bar with their friends and saying, I had a great experience, investing in this company. I got to learn a lot about an industry I never thought I would. That's a great thing for people to do, because I think what people don't understand, and I didn't really understand it, until I actually, started my first company, was you don't really learn a lot when you're investing in the public stock market as much as you think you are. Like, yeah, there's a ton of research out there and you think what, the earnings are going to be for Coca-Cola or Apple. Like, you're really not that involved and you don't have much influence, and your network is not going to help them be more successful. But where you invest in early stage, or if you invest in, small businesses or startups or whatever, you actually can have an impact on where your dollars are spent, and maybe some advice and some, support to change the outcome of the business. And you also take out the emotional roller coaster ride of the public market swings where you don't have any control. So for me, when I wrote my first check to start, the first company, it was a lot of my own personal net worth. And I said, this is my chance to get an MBA in a business that I may or may not have success at, but I will put all my effort into making sure it's a success and using my network to my advantage and leveraging, people around me to do something that I cannot leverage or use in the public markets where I'm investing, things like that. So I thought that was a really cool way to make my money go further. And that's why I've decided to dedicate my life to doing it now at Ripple.
Yeah, absolutely. And as you say, kind of there's the two sides of private market investing. Of course, you're there to make a return, and that's one driver. But the mission-led aspect of investing is huge as well. As you say, you can get in early if it's an industry or a type of business or solution that you really care about as an investor, and you can make a difference as well. Perhaps you can help, if they're very early stage as well.
Yep.
Yep.
I was just going to say, like, a lot of our family offices and a lot of our LPs and our funds are, high net worth individuals who came to us and said, hey, look, I just sold my business, or I'm looking to learn about investing in startups and venture capital. And our firm shares all of our due diligence material, our due diligence process. And our job is to create the ripple effect around our LPs by giving them the tools they need to go out and make their own angel investments after learning from the way that we do it. Just like I do with my own money, I invest in a dozen other funds as an LP to learn about how they operate to make me a better investor. And I think that's really cool.
It's definitely the future, and I think we're as excited about it as you are, and that's great. Unfortunately, we're out of time, but thanks so much for talking with us today, Matt. Really appreciate you sharing your thoughts.
Absolutely. Thanks for having me, and good luck to everyone out there.
Thanks very much. Unfortunately, yes, as I say, we've run out of time. Thanks to everyone for joining us. We will be sending a follow-up email with the links to Tank Talks and to Ripple X, as Matt mentioned, along with the recording. And thank you very much to everyone for joining us. Wish you all a fantastic afternoon and see you all again soon. Thanks very much.
Take care.
Bye.